here's an example of being, sometimes you don't have to be in the first inning. Walmart comes public. You said, gee, it's a little town in Southwest and Southeast. I'm not sure about them. So 10 years after they went public, the stock's up tenfold. It's gone up 10 places. I missed it. It's now up 80-fold since then.
Forget everything Wall Street taught you about PE ratios. If you ignore what Peter Lynch is about to share, you might spend decades working in retirement instead of enjoying it. This is the man who averaged 29% annual returns and turned an $18 million fund into $14 billion. Today, we have two big questions. Why can an expensive stock still make you rich? And why is trying to predict the economy a fool's errand? Towards the end of the video, we'll uncover Lynch's simple one-line test to invest better than everyone around you. He actually says that, so listen out for it.
So we're selling currently S&P 500, 22 times trailing 12 months earnings. Granted, earnings are growing, interest rates are falling. It sort of makes sense when you think about this being
Right.
A CapEx boom and low unemployment. There are a lot of justifiable reasons for it. Do you worry about future returns for the investor who puts $1 to work today in the market?
I'll ask somebody in the room, do we run Costco's IRA or Walmart's IRA? Because Costco's like at 55 times earnings.
Costco has an AI stock multiple, but they sell paper towels.
It's a great company, but
Yeah.
55 times earnings. Ooh. Or Walmart is 70 years old. You know, Sam Walton was at JCPenney, done this great formula, went to small towns. Imagine, here's an example of being, sometimes you don't have to be in the first inning. Walmart comes public. You said, gee, it's a little town in Southwest and Southeast. I'm not sure about them. So 10 years after they went public, the stock's up tenfold. It's gone up 10 places. I missed it. It's now up 80-fold since then. These 10 years, they're a 25-year-old company.
Yeah.
And they copied the Kmart formula. They're lower cost. They went to the big cities. They could kill Kmart, kill Sears. So it went up 80-fold after going up tenfold. Because it's a 25-year-old company, 10 years in public. They're in 18% of the United States. Then they went to 19, then to 20, then to 23.
Yeah.
And, and then they had Sam's Club. And I had the same example with McDonald's. McDonald's was my biggest position. People said, it's all over for McDonald's. I said, well, wait a second. Why is that? I said, well, how many more McDonald's can I have? Well, I think they can do really well in Europe. There's 450 McDonald's in France.
Yeah.
In France. Germany, 380. There's over 300 in England. There's 300 in Spain. There's more McDonald's outside the United States. So McDonald's went up tenfold after that. People said, McDonald's is done. They just didn't think it through.
Lynch just dropped a bomb. A great company can look expensive on the surface and still be barely in the middle innings of its growth. Even a decade after IPO, Walmart stock had already gone up 10 times. Many investors threw up their hands. We missed it. But from that point, Walmart went on to soar another 80 times as it expanded nationwide. Picture this. Tom bought $10,000 worth of Walmart in 1980, thinking he was late to the party. His brother laughed, saying he should have bought 5 years earlier. By 2000, Tom's, quote, late investment was worth $800,000 while his brother was still waiting for the perfect entry. Why? Because in that expensive phase, Walmart was only serving 18% of the U.S. market, meaning 82% was still up for grabs. Walmart marched from 18% to the entire country, obliterating rivals who seemed untouchable. Kmart went from 2,000-plus stores to just 3 by 2022. That's what happens when one company keeps compounding success while its competitors stagnate. Most of us fixate on the PE ratio. 55 times earnings for Costco sounds nuts, right? But a high PE for a dominant company with decades of growth runway is not the same as a high PE for a fad. Valuation is just a snapshot, and a snapshot can fool you if the landscape is about to explode bigger. Have you ever skipped investing in a company you love because it felt too late? A great company with a long runway will keep making new highs while skeptics wait on the sidelines. If you thought Costco at 55 times earnings in 2018 was overpriced, you watched it quintuple by 2025. This is why your neighbor who, quote, overpaid for Apple in 2015 is retired while the guy waiting for a crash is still doom-scrolling market predictions. The lesson? Growth trumps static valuation in the long haul. Lynch isn't saying ignore quality and just buy pricey stocks. He's saying look deeper. Is this business only in the first few chapters of its story? If yes, that pricey stock might just be a bargain in disguise. Speaking of quality businesses early in their growth story, that's exactly what you'll find at the Fat Alpha Value online conference on December 4th and 5th. Top hedge fund and family office managers share their highest conviction ideas. I went to the last one and walked away with 3 stocks that made it into my watch list. This isn't sponsored content. I'm sharing this because it's genuinely valuable. We've arranged a 10% discount with code IC10. We don't earn anything from it, it's just so they know you came from us and you can secure your discount. If you want to hear what professional investors are actually buying right now, grab your spot through the link below. Anyway, back to Lynch. You might be thinking, all right, Peter, I get it. Focus on the company's future, not just the PE. But what about the economy? Doesn't this all get wrecked if the economy turns south? Even the best company can stumble in a recession. So many of us hang on to every Fed announcement and GDP report, trying to time our moves. But Peter Lynch has a one-line test for that too.
Coming out of the great financial crisis, the most in vogue style of investing was macroeconomic hedge funds, because there were a small handful of people who determined that the housing crisis would ultimately bring about a recession. And those people were revered for a couple of years. You've never really been big on trying to outguess everyone else on the economy. And you said, if you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes.
Yep.
I still quote you to this day when clients call up and they want to talk about the latest labor report or what the Fed's going to do. Tell us, how long did it take you to figure that out? And how much pushback did you get when you said it from people that were economists or focused on the macro?
Well, I don't remember if Fidelity ever had an economist, so we just buy stocks. And
She's here tonight. Okay.
So I'd love to get next year's Wall Street Journal.
Yeah.
I'd pay at least $5 for next year's Wall Street Journal. Know that, and hands off to the people who did The Big Short. I had no idea how bad the housing market was, how bad people had second mortgages, they had home improvement loans, they were underwater in their house. I had no idea. Hats off to them.
Yeah.
But I look at facts, like what's happened to debt, credit card debt. You can get that now. What's happened to savings rate? What's happened to employment? I'd love to know what's happened in the future. I've been hoping I could get that in the last 81 years. It's not available. So I just deal with what's now, what's happened to used car prices, what's happened to the price of oil, and you look at industries that have gone from miserable to getting better, like Chrysler. I mean, I remember people says, gee, you were really good on that show, but how can you possibly recommend Chrysler? It's gone bankrupt. Well, they had $2 billion in cash, and they had enough money for the next 3 years. They weren't going bankrupt. So I think the best stocks I had, I think if 100 people did work on it, 99 would say, that's better than I expected. So I use this for one of our great friends, Joel Tillinghast. I wrote a foreword to his book, and I always said, the person that wins the most, turns out the most rocks, wins the game. And I said, Joel Tillinghast is a great geologist, because if you look at 10 stocks, you probably find one that's mispriced.
Yeah.
Look at 20, you'll find 2. Look at 40, you'll find 4.
There it is, Lynch's famous 13-minute rule. Spend more than 13 minutes on economic forecasts, you wasted 10. Macro predictions are mostly a distraction. Why? Because nobody can reliably predict the future. Professional gurus barely do better than a coin flip. One study analyzed over 6,500 market forecasts. Average accuracy was 47%, literally worse than guessing. Those who did call a big crash once, think of the heroes of The Big Short in 2008, were treated like oracles for a while. But how many of them nailed the next crisis or recovery? Vanishingly few. So what does Lynch do instead of fortune-telling? He doubles down on facts in front of him, current data, like debt levels, savings rates, employment trends, things that are knowable today. More importantly, he focuses on companies and not the economy. Everyone hated Chrysler because it had gone bankrupt before. Picture the scene. Trading floors buzzing with panic. Analysts on CNBC declaring Chrysler dead. Investors dumping shares like toxic waste. But Lynch dug into the balance sheet and found Chrysler had $2 billion in cash, enough to survive a few rough years. The conventional wisdom of Chrysler equals doomed was false. The facts said it wasn't about to keel over. He asks, if 99 of 100 informed people look at this stock's reality, would they be pleasantly surprised? If yes, you probably found an underrated gem. Lynch says the investor who turns over the most rocks wins. If you investigate enough companies, you will find mispriced stocks. Each stock is a rock. Pick it up, examine what's underneath. Maybe 9 out of 10 have nothing special. But that 10th one? Jackpot. While Reddit argues about the next meme stock squeeze, real wealth builds from this grinded-out approach, not some magical ability to predict recessions. While countless experts fretted about the next Fed move, Lynch was out visiting companies, reading reports, and even testing products himself in bizarre ways. When Peter Lynch says, invest in what you know, what did he really mean? Buy a stock because you like the product? Not quite. That's only step one. The real magic happens when you take that spark of insight and validate it with research.
I think that over the years, that idea has kind of been mischaracterized as if you use the product, it's automatically a good stock, which is not what you meant at all. Could you explain the difference between those two ideas and why that's so important?
Well, a lot of people, I met so many nice people earlier tonight, and a lot of them had read my book, One Up on Wall Street, and I had this story about I had a great investment. My largest position was in Hanes that had these pantyhose called legs. They weren't that sheer. They really fit. But most pantyhose are being sold in fancy department stores. This was at the supermarkets.
Yeah.
And people go to a supermarket once a week. They go to a fancy store once every couple of months. My wife went a little more often, but and I went with her. So this was an incredible success. Incredible success. But then a larger company called Kaiser Roth put the thing right next to it. And it was called No Nonsense pantyhose. So I went to 2 different stores, about 65 different pairs of No Nonsense pantyhose.
Now, what kind of look did you get from the clerk in the process of that activity?
Yeah. It was an odd purchase, but I spread it over 3 stores. But I gave it out to everybody at Fidelity.
Yeah.
And said, give me some feedback on this. They said, it's not that good.
Okay.
It's not that good.
Okay. So.
And the other one, the first stock I bought in Magellan was Taco Bell. And I had to say I own this myself. Is it okay?
Who was clapping for Taco Bell? It's not one of my people, was it? Okay.
And so I said, can I buy some stock that I own myself? I said, sure. You just can't sell it after you buy it. You have to hold on. So that's when we had Ma Bell and all these Bell companies. And so I called the trade room. I said, I want to buy Taco Bell. They said, what is Taco Bell? And I explained what a taco was. They're only in Southern California.
Yeah.
They're going to Central California. I didn't get a burrito supreme, but I explained what a taco was. Because it's basically a taco has very little meat, a lot of protein. You can sell a really good meal for a low price. And I got robbed on it because Pepsi-Cola bought Pizza Hut, and they bought some Kentucky Fried Chicken. They bought Taco Bell to sell Pepsi.
Right.
His stock would have gone to 500.
Yeah.
My largest position was 18. They bought it at 30.
Okay.
Would have gone to 500, 600. But they bought it to sell Pepsi.
Picture this. It's 1975, and Peter Lynch is standing in a CVS with a shopping cart full of pantyhose. The cashier thinks he's lost his mind. Other shoppers stare. But Lynch does not care. He's conducting field research that would make him millions. He literally went out and bought 65 pairs of pantyhose to test a hunch. Back at Fidelity's offices, he handed them out to female colleagues like Halloween candy. Try these and tell me what you think, he says. They report back, not that good. That simple test saved him from a bad investment and confirmed his original pick, Hanes, was the winner. Lynch's mantra, buy what you know, starts with your everyday life. In the 1970s, his wife noticed the Legs brand pantyhose being sold in grocery stores, a totally new distribution approach. That was the spark. If you see a product solving a problem or spreading fast, it might be a great business. But Lynch didn't stop at, my wife likes it, so I'll buy the stock. When a rival product, no nonsense, appeared, he didn't just worry, he investigated. His pantyhose testing gave him real-world data. The competitor's quality was subpar. His original thesis held. Hanes' Legs had a durable advantage. This is buy what you know, done right. Use your first-hand insight as an edge, then back it up with facts. How many of us do that kind of homework? You notice a great new gadget or a packed new restaurant chain. Do you just buy the stock on a whim, or do you turn over the rocks? Do you try the competitor's product, read the financials, see if the hype holds up? Most people don't, and that's why most people miss the big winners. Lynch's edge was never a supercomputer or exclusive info. It was his willingness to observe keenly and then hit the pavement to verify what he thought he saw. The pattern is clear. Whether it's ignoring a scary PE ratio, tuning out macroeconomic noise, or sleuthing around a grocery store aisle, the thread is focusing on knowable truths instead of noisy abstractions. Lynch invests in businesses, not stock tickers or headlines. And you can too. It doesn't take an economics PhD to realize one retailer is crushing another, or that a new product is flying off the shelves, or that a company's balance sheet is solid despite everyone's pessimism. It takes curiosity and legwork, qualities you can cultivate. Investing better comes down to playing a different game than most people. While others scramble to predict the next Fed decision or obsess over an arbitrary ratio, you'll be doing what Lynch does, sticking to facts and common sense. The secret isn't some advanced formula. It's discipline. Discipline to trust your eyes and research rather than the noise. Discipline to hold a great stock for the long term, even when armchair experts say it's overvalued or the market's scary right now. Lynch's success formula is essentially know what you own and why you own it. If you can't explain in a few lines why a company will be bigger years from now, maybe skip it. But if you can, and you've done the homework to confirm you're not deluding yourself, then tune out the rest. Picture Peter Lynch in your head next time you're tempted to react to some doom and gloom headline. He's probably shrugging, checking a company's inventory turnover, or visiting a store to see how sales are. Be that person. Become a financial detective in your own life. Your portfolio will thank you, and you'll sleep better not freaking out over every forecast. Don't forget to check out the Fat Alpha Value online event below, and if you want Peter Lynch's help preparing for the next stock market crash, check out this video next. I will see you over there.